Everyone tells you to buy Google, but there's a smarter way to own it, about 21% cheaper with $2,500 of upside, and the trade pays you $105 just to put it on. This is the exact trade I sent my Trade Alerts members on June 2nd, 2026, and I'll show you the entire setup on screen. I've owned Google stock for years myself, shares I picked up at a discount using the same exact structure. No predictions, no price targets, just a disciplined structure that wins whether Google goes up, down, or sideways. Because my job is simple: win when you're right, win when you're wrong, never gamble. And stay till the end. I'll give you the exact strike prices to run this with defined risk, even in a small account. Why Google? Search plus YouTube plus cloud plus Gemini AI. Multiple businesses, most companies would be jealous of just one. Google is also one of the most profitable companies in history. It's a true quality mega cap stock. The question isn't if you want to own it, it's whether you should pay full price today. And my answer isn't a price prediction because nobody can tell the future. Instead, I'll show you in this video a disciplined structure that gives you a substantial advantage and an edge. Why I'm not just buying the shares. If you buy the shares, you win only if they go up. You pay the full price today, and there's no cushion if the stock price drops. With this trade, you get paid to enter. You win whether it goes up, down, or sideways. And you have the built-in discount if the stock drops. Same stock, but a smarter way to own it. Never traded options. Here it is in 20 seconds. Selling a put equals a buy it on sale order below today's price, except you get paid cash today just to place it. If the stock never drops to your price, you keep the cash. If it drops to your price, you get to own one of the best companies on earth on sale. You get paid to be patient instead of paying full price and hoping that it goes up. My finance bull trade on Google. I bought the October 2026 375 call and I sold the 400 call. This is a $25 wide call debit spread and it gives me $2,500 of upside for every one contract. So if I did this with 10 contracts, it would have provided me with $25,000 of upside potential. Then I financed this by selling 2 of the October 2026 $285 puts, which is a price I'd be thrilled to own Google at. It's about 21% below where it was trading because I believe Google was trading at about the 362 level when I made this trade. This whole package was actually put on for a credit, about $105, meaning I collected money just to put this trade on. Remember, most people pay to buy a call option, but had you put this trade on, you would have actually collected money to have that $2,500 of upside. Here's the exact order sent to my members. They received a $105 credit to enter this trade. You sold 2 of the October 2026 $285 puts, then you bought the 375 by 400 call debit spread. This was sent to the Trade Alerts members on June 2nd, 2026 at 10:05 a.m. Eastern. Quick, here's the plain English version of what you just saw. You be paid $105 today. If Google runs higher, the call spread will pay you up to $2,500. If it drops, you get to buy one of the best companies on earth for about a 21% discount from what it was trading at when I sent this trade alert. If Google does nothing, you keep the cash. And in about 90 seconds, I'll show you the exact strikes to run this with strictly defined risk, which is perfect for smaller accounts. How this wins, up, down, or sideways. If Google goes up, the call spread profits to the cap, which is $400. If Google goes down to my strike price, then I'm assigned to $285. 200 shares of Google at a price I chose, and I get to keep the credit. If Google trades sideways, nothing happens and I just keep that initial $105 credit for opening up this trade. If you think that buying the shares at the current market price is better than this structure, then I disagree, because at this moment that I'm recording the video, Google is trading at about $345. So had you bought the shares at $362, you would have been underwater. And when you're long shares, you only win in one direction, if the stock actually goes up. But you want to own it. What if it keeps running higher? If you want the shares, if Google falls to $285, then you own it. Roughly 21% cheaper than where it was trading at when I sent the trade, and you still keep the credit. Are you worried that it's going to rip higher without you? The call spread profits all the way up to the $400 cap. Now remember, you are paid to put this trade on. The only thing you give up are gains above the cap. In my opinion, that's a trade worth taking every single time. You get a discount if it drops, you participate in the upside if it runs higher, and you get paid either way. Why getting paid to enter is the entire edge. Most traders pay money when they buy a call option. They need to be right on the direction and the timing. This trade was open for a credit, and time passing with a flat market, that also works for me and it doesn't hurt me. You don't need predictions. You need a better structure. The number one mistake that ruins this trade. This only works if you genuinely want to own the stock at your put strike price. Selling puts on a company you don't want equals gambling for premium. Pick the company first, the strike price second. The discipline is your edge. The honest risk. Let me be precise. This is not a defined risk trade. The put is naked, undefined risk. And it's two puts. So if Google craters far below 285, you're assigned on both. 200 shares above the market price. That's the real risk. That's why I only sell puts on companies I'd happily hold for years, and why the defined risk version is only 60 seconds away. My combined accounts are about $2.8 million. I'm going to show the larger account below. You can see that with this structure, it's very disciplined. In March 2026, when the market was down around 7 or 8%, this account was down less than 1%. And I used this exact same strategy that allowed me to get assigned shares of Google at $150 back in March or April of 2025. So I was able to pick up Google and realize about 150% profit. The real lesson, I don't have to predict Google's future price. I structured a trade that wins more than one way, up, down, or sideways. I was simply paid to be there. Win when you're right, win when you're wrong, never gamble. All right, here's what I promise you. The defined risk version, which is perfect for smaller accounts with the exact strike prices. Instead of selling the $285 strike as a naked put, instead what I would do is I would sell a higher strike and I would buy a lower strike put, and I would choose the same October 2026 expiration. For example, instead of selling the 285, I would sell the 320 and then I would buy the $250 strike. So again, instead of selling 2x of the 285 naked, I would sell 2x of the 320 put, and then I would buy 2x of the 250 put. That would substantially reduce my risk from $285 in the unlikely event that Google were to go bankrupt. And now, using those defined risk strikes, my risk would only be $70 per share. Selling the 320 strike allows me to collect more premium, and that extra premium pays for the protective lower put. This is perfect for smaller accounts. The call spread does not change. I would keep the full $2,500 of upside. That's the trade. Pay to enter. A winner whether Google rips or it dips. And a structure you can run on almost any great company or ETF. Who's telling you this? I'm a former Wall Street investment banker. I worked in Morgan Stanley, CIBC World Markets, and Pesky Prunier. I'm an Ivy League graduate with 10 plus years options trading experience. Do you want every trade I send my members in real time? The 14-day trial link is in the description. Tell me in the comments which stock I should run my finance bull on next. Your pick could be the next video. Win when you're right, win when you're wrong, never gamble. See you in the next one.